Good morning, I'm Anna Milne, Deputy Portfolio Manager at Wilson Asset Management, and today I want to talk to you about why real estate is back in vogue. In WAM Leaders, we look at the world through three key pillars: macroeconomics, fundamentals, and positioning. The macro sets the weather. These are large cap stocks tied to cycles, whether it be commodities, credit, or GDP. And when these cycles move, it drags the stocks with them. That is why we monitor cycles very closely. Fundamentals are what keeps us grounded, meeting the companies, assessing the headwinds or tailwinds, and the likelihood of earnings upgrades or downgrades. And lastly, positioning. Markets aren't mechanical, they are in fact very emotional. And with emotion comes mispricing. We see a lot of opportunities in stocks being mispriced, and this is why we focus on positioning. Now let's tie this process into real estate investment trusts, or REITs. So at a macro level, it's been a tough few years. Valuations have turned, interest costs have rose, and sentiment collapsed as a result. But things are turning. And when things turn in real estate, they turn slowly and then very quickly. And we believe we're right at the start of this turn. Fundamentally, if we step back and look at the big forces at play in Australia, there is a chronic demand and supply imbalance in a positive way for the sector, and we see this as lasting all the way to FY30 and beyond. It exists across all of the subsectors. From a retail perspective, e-commerce has just reshaped the way we use malls, and there are no more being built despite foot traffic increasing year after year. Some see the office is dead, and that is anything but the case in prime office land. In prime Sydney, Brisbane and Melbourne, you cannot find continuous floors of space because there is such high demand for these assets. In industrial, a lot of the really high-end supply is actually being converted to housing and data centres, and as a result of this, the demand and supply imbalance has grown even greater. From a positioning perspective, because equities have done so well and real estate valuations have declined, multi-asset managers are having to weigh up having overweight equities exposure and underweight property exposure, and they're having to rebalance this. We're starting to see this dynamic play out through recent transactions, and we expect this will be a tailwind for valuations over the coming years. So when we put together the macro, the fundamentals, and the positioning, it all lines up really well for the real estate sector. Now, let's bring this to life with three examples. Starting with Goodman Group. Goodman Group is our largest REITs position in the fund, and there are a few reasons for this. It was only a couple of years ago where Goodman Group was an industrial landlord. Now it's one of the largest AI infrastructure players, certainly in Australia, if not the world. And the beauty of its model is that it is not cyclical. When there are concerns about credit or macro, AI just stands out. It is a clear theme that is here to stay. Some worry about an AI bubble, which is absolutely justified. But Goodman Group has prime sites in prime global cities. They have the partnerships, they have the customers, and they have the funding. So we believe this is a very low risk play for a very high return theme. Secondly, Mirvac. Mirvac is a housing proxy on the ASX. And when you combine the RBA cash rate cuts with the government's new 5% deposit first homeowner scheme, you can debate whether this is good policy or not, but what we do know for sure is that it will be positive for Mirvac's ability to sell and settle both master plan community lots and apartments. Not only is this going to be a really strong year for both sales, for residential sales, but also margins. Residential margins are bottoming and improving. You combine this with quite negative sentiment on the name, given it has been a rocky margin recovery, and we believe Mirvac is well primed for a recovery over the coming 12 months. Lastly, I wanted to mention GPT Group. GPT has undergone a transformation over the last couple of years under new management. They were previously considered a passive, sleepy REIT vehicle, and now they are anything but. They're transforming their business and really growing their funds management side. So we believe GPT is a great proxy for the increased level of transactions that we're seeing in the market. So those are our top three holdings: Goodman Group, Mirvac Group, and GPT Group. But overall, we believe REITs are very well placed over the coming 12 months. When the REIT cycle turns, it turns slowly and then very quickly. We believe we're at the very start of that turn and are positioned accordingly. Thank you.